reviews and analyzes invoices related to capital expenses to determine compliance with GAAP in terms of capital asset accounting. An operating expense, OPEX, is an expense required for the day-to-day functioning of a business. This means a business incurs an operating expense on a recurring basis. Operating expenses include things like insurance, payroll, and marketing. A capital expense, CapEx, on the other hand, is incurred to create a benefit in the future. They are long-term in nature and are generally used to acquire things like property, equipment, and technology. A capital expenditure is incurred when a business uses collateral or takes on debt to buy a new asset or add value of an existing asset. Capital expenses include the cost of fixed assets and the acquisition of intangible assets. Capital expenses. A capital expenditure is incurred when a business spends money, uses collateral, or takes on debt to buy a new asset or to add value to an existing asset with the expectation of receiving benefits for longer than a single tax year. Put simply, it represents an investment in the business. Examples of capital expenses include the purchase of fixed assets, such as new buildings or business equipment. They also include upgrades to existing facilities and the acquisition of intangible assets, such as patents and other forms of technology. Capital expenses are recorded as assets on a company's balance sheet rather than as expenses on the income statement. The asset is then depreciated over the total life of the asset, with a period depreciation expense charged to the company's income statement, normally monthly. Accumulated depreciation is recorded on the company's balance sheet as the summation of all depreciation expenses, and it reduces the value of the asset over the life of that asset. Key differences. One of the main differences between these two types of expenses is how they're treated for tax purposes. According to the Internal Revenue Service, IRS, companies can only deduct expenses as long as they are ordinary and necessary. It defines ordinary expenses as those that are both common and accepted within a specific industry. A necessary expense is one that is considered appropriate for the business. Companies are able to fully deduct operating expenses in the same year they are incurred. For instance, it can report the total amount of annual property taxes paid on a plant it owns at the end of the year. But this same rule doesn't apply to capital expenses. The IRS classifies capital expenses as those related to startup costs, business assets, and any improvements made to a business. The IRS doesn't allow businesses to deduct the total amount spent on an asset, which means they can only deduct capital expenses based on the total amount of depreciation during a given year.